Welcome to the Deep Dive. Today, we're looking at the amazing story of Rakesh Jhunjhunwala, India's legendary big bull.
That's right.
We've got an article here talking about how Warren Buffett's ideas really shaped his whole investment approach. So our mission, let's pull out those core principles he used and see what lessons are there, especially for navigating today's markets.
Yeah, and what's so interesting, I think, is how Jhunjhunwala took these, well, let's call them universal principles, and made them work in the Indian market, which, let's face it, has its own unique dynamics.
Definitely.
So we'll break down the 5 key Buffett rules he seems to have really leaned on. It's like a blueprint he followed.
Okay, let's start with the big one, maybe the most famous. Buffett's rule number 1, never lose money. Rule number 2, never forget rule number 1. Sounds simple, right? Almost too simple.
Yeah, it does. But what does it really mean? I mean, you're going to have down days, right?
Exactly. Avoiding any loss seems impossible, especially in volatile markets. How did Jhunjhunwala actually apply that?
Well, that's the key. For him, it wasn't about dodging every little dip. It was about safeguarding his capital from permanent loss.
Oh, okay.
He famously avoided really speculative stuff, those hot tips everyone chases, even if they look tempting.
Right.
He focused instead on understanding the business, its real value. That analysis limited his downside. It wasn't about market timing. It was about value guarding his principal.
Got it. So protecting capital first. That leads nicely into the next idea, which he clearly mastered. Stick to what you know. Invest only in things you genuinely understand.
Exactly. And think about India, over 5,000 listed companies. It's overwhelming.
Yeah.
But Jhunjhunwala was disciplined. He had his circle of competence, sectors he knew well, like cement, metals, later even some digital stuff, but always grounded in fundamentals.
So doing the homework?
Oh, absolutely.
Yeah.
Really digging into annual reports, looking hard at cash flows, not just profits, and assessing management. Were they transparent? Good capital allocators. He preferred, maybe 10 to 15 stocks he knew inside out, rather than spreading himself thin.
Depth over breadth. Okay, that makes sense. But then there's patience. Both Buffett and Jhunjhunwala preached it. But it's tough, right? Especially when things get choppy or everyone else seems to be getting rich quick.
Oh, it's incredibly tough.
Yeah.
And Jhunjhunwala's own journey is proof. He actually started more as a trader, then shifted to being this long-term value guy.
Right.
Patience was central to that shift. Think about Titan Company, the watch and jewelry maker.
Yeah, famous example.
He held that for, nearly 20 years? Bought early 2000s, held through ups and downs, reinvested dividends. Just let compounding do its thing.
Wow, 2 decades.
Yeah. His conviction wasn't just in the stock, it was in time itself. Markets go crazy, but good businesses, fundamentally, tend to grow over the long haul. He had the stomach to just sit tight.
And that Titan story flows right into the next rule, doesn't it? Buy quality and hold it long term. It's not just patience, it's patience with the right stuff.
Precisely. It's not just time in the market, it's time in the market with quality.
So what did quality mean for him?
Well, like Buffett, he looked for businesses with sustainable advantages, those moats, strong financials, consistent growth, and really important ethical management that cared about shareholders. He wasn't scared to pay a fair price for a great company because he knew its value would likely compound way beyond that over years. He wasn't flipping stocks, he was partnering with businesses. Are you thinking that long game?
That's a good question for everyone. Okay, final rule, and maybe the hardest. Be greedy when others are fearful. Buffett said it famously in '08.
Yeah, the ultimate contrarian call.
How did Jhunjhunwala pull this off when panic set in?
It really takes clarity, doesn't it? Seeing opportunity when everyone else sees disaster. He had this knack for spotting good, undervalued companies when the market was just overly pessimistic.
Like in 2022.
Exactly. During that correction, when people were selling off, he was strategically adding, especially in sectors like healthcare, that he saw as resilient. He saw fear, creating discounts on great businesses. It takes courage, sure, but it's courage backed by that deep analysis we talked about. That's what set him apart.
So, wrapping this up, the principles from Jhunjhunwala, heavily influenced by Buffett, they aren't really secret formulas. It's protect your capital. Know your field, be patient, pick quality for the long run, and have the guts to act when everyone else is scared.
Absolutely. And, these aren't just investing rules. They feel like a framework for making smart decisions, period.
Yeah.
So the question this deep dive leaves us with, maybe for you listening, is how could adopting this kind of long-term, value-driven, sometimes contrarian mindset change how you tackle challenges or spot opportunities in your own life, financial or otherwise?